Alright, and here on our news from Times Tabloid, it says Dark Defender makes major XRP Rich List reveal that it stuns XRP army. Right? Now, while retail traders were busy staring at the 24-hour price charts, panicking over every single red candle, something absolutely massive just happened behind the scenes. Think about a massive puzzle where someone is quietly buying up almost all the remaining pieces while everyone else is fighting over the cardboard box. That is exactly what just played out in the XRP ecosystem, and the sheer scale of it has stunned the community. A major data reveal from the XRP Rich List has just exposed a historic shift in token ownership. We aren't talking about everyday buyers picking up a few hundred tokens. We are talking about deep-pocketed entities executing a coordinated accumulation campaign where the public was looking the other way. So in this video, we are breaking down the exact numbers, who is taking control of the network, and what this extreme concentration means for the liquid supply moving forward. Alright? But before we continue, let's have a short technical analysis on XRP right here. XRP is now currently at 1.1908 USDT. And here on our chart, this is a daily chart time frame. We can see that XRP back on June 15, it managed to close above our major resistance right here at $1.2234. And we thought that it was a bullish breakout, but it ends up being a false breakout because the next day, June 16, it formed a bearish candle which closed below our resistance right here. So that is a confirmation that this is a false breakout. But other than that, we can see that our signals are still giving out bearish signs. So the next candle, which is yesterday, is finally another bearish candlestick where its body is completely below our major resistance right here. So we are back from consolidating, and my analysis for this coming few days is that the price of XRP might consolidate just below this major resistance right here at 1.2234, unless we have another major news that could affect the market. All right, now let's go back to the news and let's answer the very first question about what did the XRP Rich List just reveal about whale ownership. The numbers coming out of the blockchain tracking tools right now are staggering. According to recent network metrics highlighted by the analyst Dark Defender right here, wallets holding 1 million or more XRP, right, have aggressively expanded their positions. Over the last 6 months alone, these massive high volume addresses added a whopping 1.53 billion XRP to their balances, right? 1.53 billion XRP in 6 months. To put that into context, these millionaire tiers don't just own a large chunk of the network anymore. They practically control it. The public ledger confirms that these specific addresses now hold 49.8 billion tokens out of the total 67 billion circulating supply. That means a mere handful of top-tier accounts now command roughly 73.3% of all available XRP in existence. As a market observer, my personal opinion on this is very clear. This is not random trading activity. When a tiny group of addresses absorbs 1.53 billion tokens in half a year window, it represents a definitive institutional grade positioning strategy. This isn't retail FOMO or speculative day trading. This is a cold, calculated cornering of the asset's float. The whales are looking years ahead, and they are using this quiet period to build an unbreakable floor under their portfolios, while ordinary holders are distracted by short-term volatility. Right? Now, the next question is, why did whales strike hardest when XRP traded near $1? To understand why this accumulation is so critical, you have to look at the exact timing of these giants' purchases. This massive multi-billion token buying spree didn't happen while XRP was flying high or breaking records. It happened during extreme price consolidation, specifically stretching into early weeks of June 2026, when the asset dipped to a low of around $1.03. During the decline, the retail sentiment was incredibly low. Social media was flooded with complaints, traders were getting stopped out, and many retail participants simply threw in the towel and sold at a loss. But look at what the wealthy accounts did. Instead of panicking, they used $1.03 as an absolute buying zone. They treated the retail sell-off like a premium clearance event. My personal opinion as a market observer is that this highlights the massive psychological divide in crypto. Retail investors focus entirely on immediate gratification and daily price pumps, which makes them highly vulnerable to shaking out during corrections. Whales, on the other hand, trade purely on structural value and liquidity cycles. They saw $1.03 as a gift. They willingly absorb the panic selling of the public because they understand that wealth in this market is fundamentally transferred from the impatient to the patient. They didn't care that the market looked weak. They only cared that the asset was cheap relative to its long-term institutional roadmap. Right? Now, how does this supply concentration create a major liquidity squeeze? When you take 74.3% of an entire asset class and lock it away in a giant long-term storage wallet, the mathematical reality of the open market changes completely. The amount of XRP sitting open on digital asset exchanges has already plummeted to historic lows. Think of the market like a premium real estate market. If a few large developers buy up 74% of all the houses in a city and refuse to sell them, what happens to the price of the remaining homes when new buyers arrive? The price goes up exponentially because the inventory is virtually non-existent. With 3/4 of the supply firmly locked in millionaire wallets, the remaining 25.7% has to satisfy the entire retail market, global payment corridors, and institutional liquidity pools. Right? From my perspective as a market observer, this is setting up the ultimate supply crunch. Retail investors don't realize they are slowly being squeezed out of the asset entirely. As liquidity on exchanges dries up, it will take significantly less trading volume to move the price upward in the future. The whales are intentionally creating an environment where the available float is so tight that any sudden burst of demand will cause an aggressive upward revaluation. They are making sure that when the macro environment shifts, they hold all the keys to the kingdom. Now, our next question is, why is capital imbalance keeping smaller investors on the sideline? One of the most telling aspects of this entire whale migration is how the community itself is responding. Many participants on X have noted a painful reality, where the average retail holder simply doesn't have the cash reserves to compete with these entities. So if your portfolio is under $100, $100,000, you likely don't have secondary streams of massive capital waiting to buy a million more tokens every time the price drops 10 cents. Retail traders are often fully invested at higher prices, leaving them with no ammunition left when a premium buying opportunity like $1.03 presents itself. They watch the dip happen, wish they could buy it, but are ultimately forced to sit on their hands while the wealthy buy everything in sight. So in my personal opinions on this structural imbalance is that retail needs to change its entire game plan. You cannot trade like a whale if you don't have the capital of a whale, but you can think like one. Smaller participants need to stop trying to time every macro trend or over leveraging their accounts. If you don't have the liquidity to buy every single dip, then your best weapon is time. By holding your ground and refusing to surrender your tokens during manufactured downside liquidations, you effectively deny the whales the cheap supply they are looking for. The only way retail wins is by refusing to hand over their assets during periods of artificial market weakness. Right? Now, what is the overall conclusion of these historic shifts? The data exposed from the Rich List paints a definitive picture of where the XRP ecosystem is heading. We are witnessing a historic, quiet migration of wealth. The fact that wallets with over 1 million XRP have swallowed up 1.53 billion tokens in 6 months, climbing to a dominant 74.3% control of the circulating supply, proves that the largest market participants are highly confident in what is coming next. This massive concentration of supply directly limits the amount of token afloat available to the public and severely drains exchange reserves. While retail panicked during the drop to $1.03, the smart money quietly built a massive fortress of accumulation. Ultimately, this data tells us that the structural foundation of XRP is stronger than ever, even if the daily price action looks boring to the untrained eye. The supply is consolidating into strong institutional hands at an unprecedented pace. For anyone observing this market closely, the takeaway is clear. Pay attention to what the largest capital allocators are doing with their money, not the retail crowd is saying on social media. The wealth transfer is actively happening, and the history shows it pays to stay on the side of the whales. Alright? And this finally ends our video. Thank you very much for watching and see you on the next one. But you might as well just watch this recommended video right here.